Okay, so just about 2 minutes to go for the pre-open session to kick off, and it's going to be a lower start, but will we stay lower, or is there going to be a turn, which happens? We'll see. Manoj Muralidharan is Vice President Derivatives at Religare Broking. Is joining us now. Manoj, good to have you with us here. So exactly that question. What's your sense today? Is it going to stay down or attempts at some kind of a bounce through the course of the day? We had many of those yesterday. What's your sense?
Good morning, Prashant. Prashant, the irony here is this is the rollover time, and unfortunately, the October futures for the Nifty also they have a base. If you see yesterday, 17,150 levels was not reached, and we saw the selling come almost 3 to 4 times intraday. So with the rollovers almost at 40-41%, I believe that at least half of the positions for the October series in Nifty has been into a short roll with 17,150 as the base. So there is a possibility the Nifty slides down to a 16,600. But intraday specific, at least for the short term till tomorrow's expiry, a better trade here is 16,950 to 960 on the Nifty becomes a good level to go short. Again, for a 150, 200 odd point, 16,700. For the bank Nifty, these levels would be around 38,750 to 800, where we can short or go for a put option for tomorrow's expiry. The target on the downside will be somewhere close to 38,000.
Okay. Individual stocks?
We like IT as a sector, and we believe that there is some index management, if I might say that, because we've seen the banking money come out of banking, and it is actually going into some pharma and IT stocks. So we like Infosys here, and we recommend buying a 1440 strike October series. Try and buy it between a 30 to 35, keep a stop loss of 15, and a target could be an ambitious 60 on that. Even on the short side, Kotak Bank is one we believe that there is some more downside, so we can go for a 1760 put option. Try to buy it between 35 to 38, keeping a stop loss of 20 and a target close to 62 on that.
Okay, that's on Kotak Bank. Thanks a lot for joining in, Manoj. Have a good day. That's Religare Broking with their views on the markets as well as on individual stocks. I want some thoughts from Deven Choksi. Deven, we are heading into the festive season. We have the auto sales coming up in a few days from now, and things have been looking good. We've talked about M&M ad nauseum, but I also wanted to ask you about what's happening with Eicher Motors, because the initial reports on the new Hunter is very good from Royal Enfield stable, and Eicher Motors has been doing exceptionally well. Do you like that stock from a long-term perspective?
Yes, Sonia, I think the company remains, very, very strong as far as their portfolio of products concerned. And definitely, I think as you rightly pointed, the new launches are getting tractions. That should get reflected into numbers. Maybe not fully in this particular quarter, but in subsequent quarter as well, as we gather from the demand scenario. The stock price has already moved up, but I would like to see, the automobile companies in the portfolio largely from the point of view that next 2 to 3 years from now, we are seeing higher amount of growth continuing in most of the segments, including in commercial vehicle segment. In fact, we are extremely convinced about commercial vehicle segment. So where I believe that the business situation is probably unfolding, big time into a larger group. Companies like Eicher certainly would remain in the portfolio for the reason that I explained on the commercial vehicle side, along with companies like Tata Motors and Ashoka.
Right. Devin, stay with us. By the way, the flash at the bottom of the screen, the rupee is almost at 82 against the dollar, of course, which will be a record low, a new record low. This, of course, is, the broad dollar strength. The DXY, for example, the DXY index, for example, or even the Asia dollar index, they've been moving higher in a very, very fast way. The DXY, for example, at 114.5. And that's putting pressure on most currencies around the world. Forget emerging market, developed market currencies. Look at what's happening with the pound, look at what's happening with the euro, the Swiss franc. The yuan, for example, is at 7.1, 7.2. And we've got the rupee here, which is coming off a little bit as well. So that's currencies for you at this point in time. But I think, Sonia, two-wheelers and autos are in focus today.
So numbers are coming out, right, in a few days from now, and the expectation is that overall things will look good, especially in the passenger vehicle space, particularly for SUVs. But for two-wheelers, it's been a lukewarm start to the festive season, according to Elara Capital. Key rural states have been underperforming for a while. Are things going to improve? Jay Kale, Senior Vice President Research at Elara Capital, joins us now to talk more about that. Jay, at the onset, just tell us what is the expectation from the festive season this time? Do you see a big improvement in two-wheelers overall?
Yeah, hi, good morning. So, festive season, like we mentioned in our note, has started on a has got a lukewarm start. The Ganesh Chaturthi and Onam festival in Maharashtra and Karnataka especially. As per Vahan data, we compare it more to the FY19 volume peaks. That's around 20% odd lower. There has not been much improvement versus what was going on from April to August. That's how we compare the performance of the festive, because YOY might look a double-digit growth, but that's not really the true metric because of the low base. But going forward, I think what is important is that the rural states like UP, Bihar, Jharkhand, Rajasthan, etc., have to bounce back because they constitute for a large portion of the festive weightage. Typically, the 32-day festive period retails 2x the normal sale month of retail. So it definitely has a large weightage. The trends in July, August have further weakened in rural states versus what the marriage season trend was in April to June. So that is a cause of concern. And we would want to monitor that in the festive season. However, I would like to point out that for our estimates to be met for the full year FY23, the ask rate for the festive season is not too demanding. It's just around 7% on a YOY basis for the Navratri plus Dashera plus Diwali festive period, which we believe is achievable, but that factors in some bit of recovery in the rural markets, which till now have been elusive. So we are gunning on a pent-up demand and non-agri rural demand bouncing back, which needs to be monitored.
Jay, hi, good morning. Let's talk about some individual companies. iShares has been the strongest stock. What's your view here? That's, of course, in premium segment. So maybe a bit immune to rural slowdown, but your views here?
Yeah, definitely. iShares does have a lower contribution from the rural states, and the urban doing relatively better does have its positive rub-off on the overall market shares as well. Apart from that, the newly Hunter launch, of course, these are initial days, has garnered decent enough response. But we have to see how that sustenance comes in post the cannibalization of the existing models. So while we believe over the next 2-3 months, iShares numbers could look good because of the festive demand coming in and channel filling for the Hunter new launch model, we believe that the street is over-enthused over the next couple of years, replacement demand kicking in. And we've seen historically that post the initial phase of the new launches, the volumes are not able to sustain itself. We've seen that for the new Meteor, we've seen that for the new Classic 350. Overall portfolio volumes have not been able to meet street's expectations. So we currently have a sell rating on iShares, and we believe that next 2-3 months could be good, but post that sustenance needs to be monitored.
What about TVS Motor? I mean, it's been one of the strongest stocks in the space. It's been hitting new 52-week highs almost on a daily basis. On the valuation parameter, how does it stack up now? And is the risk reward still favorable for a long-term investor?
So I think TVS Motors does have, they've been one of the only companies in the two-wheeler space who has a very strong success rate of new launches. And hence the street is betting on, with their upcoming new launches in the EV side, etc., they will continue to do well. From an engineering standpoint, I think they are one of the best placed to capitalize on this, emission norm change as well as the technology change to EVs. There are some downside risks to the export market, but I think overall, given the market share improvements that they're seeing in scooters and motorcycles, and with the margin improvement, I mean, after a long time, they are sustaining the 10% EBITDA margins in a challenging environment. And with commodities softening, that could improve further. So it will continue to remain a very strong earnings growth company, one of the highest in two-wheelers, and that will lead to the evaluations remaining expensive. So we are positive on the stock.
Okay, positive on TVS Motor. And how about some of these plays that, of course, TVS also has an exposure to Europe, but to a high exposure in exports. But I wanted your thoughts on, the others like Bajaj Auto, where there are problems not just in Nigeria, problems in Egypt as well, and exports have gotten hit quite badly. Do you think the worst is over, or is there more?
I think the exports of the for the two-wheelers, especially in the which are mainly in the African, LATAM, and Middle East, Southeast Asian countries, they are expected to see some downside risk. I mean, I think the street is still not factoring in a big decline in FY23, which I wouldn't rule out that possibility given what the last 2-3 months trend is and what the outlook for the next 2-3 months is, especially in these countries. And Bajaj Auto has the highest revenue exposure from exports in the two-wheeler pack, close to around 45-50% of revenues comes in from exports, and maybe even higher profits from exports. So that stock, while domestic recovery will aid them in the near term, but exports will keep that stock under range bound at current levels.
Okay, Jay, we'll leave it there today. Thanks a lot for joining us. So that's the view on autos from Elara. The market, by the way, has settled in pre-open slightly better than what the SGX Nifty was telling us. 16,870 on the Nifty and 277 points down on the Nifty Bank at 38,080. The broader market has been under some selling pressure. Yesterday, of course, it sort of did better, but that's something to keep an eye on. In the broader market, Motherson Wiring, by the way, is the top gainer. It's up about 5.5%. Don't talk about the stock a lot, but that's doing well. In the index, Cipla has been one stock which has been an outlier. It's at 52-week high, and that is the only stock with some gains in the pre-open along with Powergrid. But on the way down, you have Reliance, which is down 1.5%, and a couple of these IT names. So, Darshan, if we start here, do you trade the index, and what's your 9-10 call?
No, if we start here, I'll still wait for support to become visible. That may or may not happen today, and there's no rush. Hindalco is an intraday short with a stop above 380.
Hindalco is a short. Okay, Mitesh, what are you going with for 9-10?
I'll also go with the sell call. That'll be a sell on Hero Motors with the stop at 2680 for targets of 2570.
Okay, Motherson Wiring has that bonus issue that they'll consider on the 30th of September. That's 2 days from now. And ahead of that, Motherson Wiring is up almost about 5.5%. Torrent Pharma, the Curatio acquisition is a bit on the expensive side. Hence, Torrent Pharma is down about 2.2%. But more on that from Ekta. She joins in now. Ekta, over to you.
Thanks for that. Well, yes, it's definitely a big acquisition for Torrent Pharma, where they are shelling around 2,000 odd crores. They do have a strong presence in the cosmetic dermatology segment, and they have important brands in their portfolio such as Teddy Bar, which is in the pediatric segment, Before Nappy, which is a nappy rash cream. And interestingly, top 10 of these brands are around 75% of the company's sales. They are expecting the sales to grow to around 275 crores versus 224 crores in FY22. But some of the concerns which is probably going to weigh down on the stock today is that the deal is expensive at around 7 times sales to price on an FY24 basis. Margins of the acquired business is slightly lower, and 75 to 85% of the deal is going to be funded via debt.
Okay, thanks a lot for that, Ekta. The stock's down 2.5% in pre-open. Let's go across to Vivek. Some news on BHEL, Vivek?
Well, that's right. As we highlighted earlier, after quite a gap of 4 to 5 years, finally we are seeing some order wins as far as thermal power capacity addition is concerned. So BHEL has actually received a significant order win for the Talchal thermal power plant that's been commissioned by NTPC. Now this particular project will be done on an EPC basis. Macquarie has reacted to this particular order win, and what they're saying is that this is an order win on a brownfield project basis, and they expect the order value to be in the range of 8,000 crore rupees. Now, what Macquarie is doing is they're actually tempering expectations in terms of thermal power capacity addition. They're saying that they have baked in 21,600 crore of order inflow as far as FY23 is concerned, and they don't really expect a full-blown revival. So what they're saying is that going forward, renewable capacity addition will be the key driver of incremental capacity addition.
Okay, Vivek, thanks a lot for that update. So that's on BHEL. The currency move, by the way, is very interesting because keep in mind, we have very interesting sort of next couple of days lined up. Today is the weekly expiry on currency futures. Tomorrow we have the full monthly expiry on the Nifty and Bank Nifty and stock futures, and on Friday again a weekly expiry on currency futures. So very sort of volatile phase of the market for the last 3 or 4 days. The stock that's taken a hammering over the last few days though is Hindalco. Just pull out that stock. It's down 16% this month, and from the highs it's down 42%. Now that is the issue with playing with cycles. You never know when you're entering at the top. Mitesh, chartically, how's Hindalco looking? Too late to short, too early to buy, or I mean, is there a trade here?
Yeah. So Anuj, I think the trade is on the negative side. We had stock going down from 600 plus to about 300 levels and then bounced back to 450, retracing about 50%. And now restarted the journey on the downside. Just for a fresh entry, you would want to sell it closer to about levels of 385 and 394, 395 being the stop in. I think the stock would go down to at least 340 and maybe in the worst case scenario even retest the lows of around 310.20.
Okay, 310.20 is possible in the worst case scenario. Well, just look at the market setup now, and then of course we'll count down to the market open. The Bank Nifty is the one which is starting about 3/4% lower. Actually today, at least in the pre-open, it's secular. Everything is down about 2/3% to about 3/4%. So Sensex, Nifty, the mid cap, the Bank Nifty, Reliance, TCS, Infosys. These are some of the names which are sort of dragging the market. If we open here, we'll actually be now quite lower from that falling trend line, which comes in at 17,700. So that will be very interesting. The next level to watch, of course, will be 16,641 on a closing basis in terms of that lower low that we had. But the first rates are in. The Nifty is down about 132 points, make it 125 now. So, okay, 139 down on the Nifty and 328 points down on the Nifty Bank. So let's see how things move from here. For now, 16,864 is what we have. Let's look at individual names then, and well, it's across the board 1.5% down take. Reliance is leading it with 1.5% down move. Infosys is giving it company with 1% down take. ICICI Bank is down about 1%. Hindalco, JSW Steel, Eicher Motors, Adani Ports, Tata Motors, ITC, IndusInd Bank, all down close to 1%. HDFC as well. The gainers list is very small. It's Cipla and Power Grid. Otherwise, it's all on the downside. But not everything is down a lot. Index stocks are down just between 1.5%, and that's why the Nifty is down, but not out. But let's see, 16,876 for now. Sonia, what about the broader market?
It's not bad. It is down, definitely. The mid-cap index is down 200 points or so. And the advanced decline ratio is not that good. But compared to other indices, say like the Bank Nifty, the mid-cap index is still down 0.7%. Let's take a look at individual stocks, what's dragging it lower. Banks, definitely Bank of Baroda, Canara Bank, PNB, IDFC, First Bank, Federal Bank, the whole lot is down about 1 to 3% Yes Bank as well. IDBI Bank, RBL Bank, nothing is spared really in the banking space today. A lot of these sectors that had a good rally are seeing some profit taking. So defense, for example, BEL is down almost about 1% or so. You have a couple of others as well in the broader markets. Samvardhan Motherson is down about 3%. Keep an eye out on that. But on the flip side, Motherson Wiring, on the back of that impending bonus, is up about 5%. Zomato under pressure, down about 2-3%. A couple of stocks that are in the news, perhaps you'd want to take a look at them. BHEL has bagged that order for a thermal power project for NTPC. So BHEL is holding up in the green. NHPC, one of its under construction projects, is seeing flooding. So NHPC is a tad bit in the red. Torrent Pharma on that acquisition, which is slightly on the more expensive side. Torrent Pharma is down 4.5% right now. And Gujarat Alkalis, one of its plants has started manufacturing hydrazine hydrate. So, just something on the business side. But Gujarat Alkalis is holding up as well. Otherwise, it is a weak market. I mean, there's no two ways about that. The Nifty is now down almost 140 points.
Oh yeah, 140 lower. So Adani Green is down 2%. Canara Bank is down about 2.25%. There is Zomato, which is down about 2%. Bandhan Bank is down 1.75%. Motherson is down 2%. Nazara is down 2.5%. Piramal Enterprises is down 1.5%. Just listing names with some volumes right now. 3:1 is the declines to advances ratio at this point. And I will come back and look at more names in terms of what's moving around at this point in time. All right. Our market master is ready now. We have Sanjeev Prasad, Managing Director at and co-head at Kotak Institutional Equities. Sanjeev, great to have you with us here on the program. Thanks very much. You know, in your latest note, you write that the RBI may be forced to hike rates much more than what it would do if it was only trying to tackle, local inflation and trying to sort of cover its mandate. But the big problem is that, you've got developed central banks led by the Fed raising rates quite substantially, and that will exert upward pressure rates here as well. Do you have any sort of a broad sense of how much, what is the extent of rate hikes we'll have to do? Because there is a currency, there is consequently imported inflation. Your sense, Sanjeev?
Too many variables out there. So our earlier view was that, we could get away with a shallow interest rate cycle this time around, and policy rates would have gone up to 5.75 to 6%. When I say policy rate, repo rate from a bottom of 4%, but now it looks like it could be somewhat higher for two factors. One is one which you already mentioned about RBI being forced, to react to whatever the US Fed is doing in terms of raising rates much faster than whatever the market had thought about earlier. So if you look at the US Fed rate expectations in June, somewhere the market was assuming the peak would be somewhere about 3.5%. Now with that expectation has gone to more like 4.75%. It will stay there for a longish period of time. And given the strength in the dollar because of the US Fed tightening well ahead of other central banks, I guess every other central bank will be forced, to in a way manage the external situation / currency also. So just not a case of inflation. It's just also the external situation and the hemorrhaging with the currency they're facing against the US dollar that they have to manage. On the second point about domestic inflation, I don't know. I mean, earlier I was quite hopeful that food inflation will start coming off pretty sharply in the second half of the current financial year. Given the quality of monsoon this time around, it looks like that may not be the case. Anyway, we'll see over the next 2-3 months. We'll have a better handle on that. But that's also one more risk I'm seeing. That food inflation could be slightly on the higher side. So if I put everything together, based on domestic inflation is slightly higher compared to what we assumed earlier, plus the external situation, it looks like we are looking at a policy rate closer to 6.5%. And I hope nothing goes wrong on the oil front. Thankfully, oil is at $85 a barrel, which is giving us a lot of breathing space, both in terms of inflation as also CAD and cash/POP. So hopefully it stays there. Otherwise, this equation may change for the worse if oil goes up to 100, 110 kind of a number.
Sanjeev, good morning. So in current environment, what is the portfolio stance? I mean, what kind of stocks do you want to buy? What kind of stocks do you want to avoid?
Sit on cash. It's a tough one, to be honest with you, because the defensives, the so-called defensives, whether it is, consumer staples or pharmaceuticals, at least consumer staples, none of them are really cheap. Many of them have, in terms of multiples, seen an expansion over the last 3 years. If you compare, for example, multiples of any of the consumer staple names in March 19 and current 12-month forward P. And why I'm using March 19 as a base, because roughly bond yields were at similar levels at that time. 10-year G-Sec was somewhere about 7.3, 7.4%. Multiples have actually gone up over this time frame. So obviously, given the valuation issue, even consumers, I'm not sure there's such a great defensive from a valuation standpoint. They will probably hold up probably better than the rest of the market. Pharma looks okay. Valuations are reasonable, I would say. Domestic pharma businesses are doing actually quite well. So there is some, I guess, chances stocks holding up relatively better over there. IT is probably starting to look more interesting given the derating which it has seen and the tailwind you could get from the currency side, which could offset some of the negatives of somewhat weaker demand. So there are the three pockets, I assume, where you have some, hopes of, I guess, preserving capital. Everything else will probably get hit. Banks is a tricky one because, from a valuation standpoint, they look actually quite reasonably valued. And macroeconomic fundamentals at this point in time, look quite okay for the banks. Credit growth is picking up and asset quality is no longer an issue. But, these are ultimately high beta names. If they have bad news for the economy, in terms of either inflation surprising on the upside for whatever reasons, banks probably will take a bigger hit in that case. So honestly, hard to construct a portfolio. Yeah, you could have consumer staples, pharma, some amount of IT, telecom, and banks, and hope that, you don't see too much of damage.
Well, you can only live in hope, right? For the market now, it's still down about 1%, but there are some stocks that are bucking the trend. Route Mobile is one stock that has been gaining ground ever since the company spoke to us yesterday, and in fact, they raised their guidance in terms of earnings, so 2.5% higher there. Tube Investments has been gaining quite a bit of ground. Mahanagar Gas, Blue Star, Chola Finance up almost 2%. Sanjeev, you briefly mentioned IT, that it looks interesting, but just a little more on that. Would you stick with the large cap IT names purely because there's some degree of safety there? Or do you think now you'd look at, some of these mid cap names? I mean, KPIT Technology was telling us yesterday that now they've become the largest global IT integrated player in the automotive space. And they're absolutely not worried about this slowdown. Would you like names like that, KPIT, Tata Elxsi, in specific spaces like auto, or would you stick with the larger guys?
The mid-cap IT companies, they have their own strengths in certain pockets. So if you are seeing those pockets holding up reasonably well, that is demand from those pockets holding reasonably well, then you're okay. But I would assume there is some sort of a broad-based slowdown when it comes to IT spending in calendar 2023, depending on how deep the US slowdown is, and God forbid even a recession. So clearly, discretionary spending by IT companies will get cut. And depending on which segment you are in, if it is more exposed to some sort of a cyclical industry, that is your client base is in a more cyclical industry, there you could probably see more cuts. So yeah, you have to be slightly careful about how you want to look at it. The larger IT companies, they have fairly wide exposure to a bunch of sectors, so their impact may be somewhat more mitigated depending on what sector exposure they have. For example, let's say healthcare exposure may be somewhat better compared to having exposure to the banking sector. So it depends what you have. So for mid caps, specifically you'll have to look at where is the client concentration, and then accordingly take a call. Valuation wise, everything else is actually looking quite okay because you have seen a fairly deep de-rating over there. You could see some earnings upgrades on the back of where the rupee is currently. And you factor in the concentration risk for specific companies, and then accordingly take a call.
Sanjeev, you and your team put out a very interesting note. The title was, of course, it caught a lot of attention. Will everybody in India drive a Maruti only? Was the title of the note. And you said that your reverse DCF valuation exercise for Maruti stock showed that the stock is implying absolutely improbable volumes in the medium term. 1.2 crore in FY42 and 3 crore plus in FY52, which is even higher than China's peak annual volumes. Now, just 2 points. One, does this account for the premiumization drive, which Maruti has of course been talking about, and second, are you seeing this kind of just volume-led sort of dislocation in other stocks, other companies as well, or just Maruti? Go on.
No, I think you would see that same thing in sectors which have sort of a finite size. India, everything will grow for a very long period of time, but I'm making a distinction. For example, consumer staple companies could have a much longer runway of growth, compared to, let's say, a cement or a auto company. For example, if you look at two-wheelers, for example, you already see household penetration somewhere about 60%. So I assume growth will clearly slow down from here. Maruti, obviously, four-wheeler penetration is hardly anything in India. It will grow for a very long period of time. But it's just that what the stock is factoring in, it's very hard to reconcile that with the with the kind of volumes India could have on, let's say, a 20-30 year basis. So whatever the enterprise value of Maruti is currently, if you do some sort of a reasonable reverse valuation exercise, that's what the numbers are turning out to be. And if you look at the profitability numbers, in fact, we are assuming somewhere about 100,000 rupees or 1 lakh rupees EBITDA per vehicle in the outer years. The peak EBITDA per vehicle for Maruti was about 68,000, if I remember correctly, in FY18 or 19, something like that. So our assumptions are not very conservative when it comes to profitability. So in a way, we are building in all sorts of optimism about higher profitability whether it is premiumization or whatever it is, so it's already factored in. So if I actually bring down the profitability numbers, the implied volume numbers will be even higher, which is absolutely impossible, given the fact that at peak volumes for China were somewhere about 25 million vehicles. So it's impossible. Maruti itself will be doing about 30 million vehicles, obviously they've got a place also in India. And the other issue for Maruti is, it is talking of premiumization, but, its strong point still remains the entry-level segment, and if you look at the SUV segment, which is the next segment, the compact SUV segment, Maruti has lost a lot of market share over there. So I think the more immediate challenge for Maruti is, to get its market share back in the SUV segment. And clearly, we have seen a big market shift away from hatchback to the to the SUV segment.
Absolutely.
So Maruti has some challenges currently, I would say.
No, I completely agree. I mean, this challenge in the SUV segment is real, right? There's already well-entrenched players like the Creta, Seltos, etc. And now you have the Toyota Hyryder, the Skoda Kushaq. And to be fair, Maruti, I mean, the pricing of the Grand Vitara, we were discussing this yesterday, is not great. I mean, it's not as attractive enough to allow it to penetrate this segment in a big way, right? Take that point. One way of gauging consumption perhaps is to look at credit card spends. So I just wanted your thoughts before we move on to the next guest, which is the management of SBI Cards that's joining in. But just as we close this conversation, Sanjeev, your thoughts? Because card spends have gone up, the customer base has gone up as well. Is this a segment that you like?
Yeah, we're quite positive on the credit card business, and SBI card is also there in our large cap recommended portfolio. See, the thing is, the middle income and high income households have largely been not affected by COVID. In fact, they have done relatively better. And discretionary consumption is coming back in a big way. It's already there, actually, when it comes to travel, tourism, etc. That's already coming back in. So that would naturally aid, spending through credit card, something which was clearly not happening over I guess, FY21, 22, probably a lot lower than what would have been the case otherwise. Also, as e-commerce, online commerce keeps on, making deeper inroads into not just middle income households, but probably even lower. But again, credit card should do relatively better, I would assume. So that way, the tailwinds are there for the sector. Of course, you have other issues of, how the MDR issues, etc., get resolved, but maybe the SBI card management may have a better sense on that one.
Okay, yes. In fact, we are going to go across to the management right now. So would invite you to listen in if you want. And of course, give us your thoughts later. Thanks a lot, Sanjeev, for joining in. That is Kotak Institutional Equities. They have SBI cards on their list in terms of in their portfolio, that is. So let's move on and talk to the management about it. SBI cards saw a rise in spends and the customer base in August. To get a sense if this is sustainable, Ram Mohan Rao Amara, who's the MD and CEO at SBI Cards, joins us now. Mr. Amara, thanks a lot for joining us. Is this sustainable, this growth that you saw in both spends, card spends, as well as the customer base? And can you give us some numbers on what the average run rate could look like?
Good morning, Sonia. Coming to the run rate, as we shared in the past, we have been targeting to achieve a run rate net growth run rate of 300,000 per month. It was a gradual. We were hovering around 200,000 a few months back. Now we were able to make it up to 296,000 in the month of August. It is sustainable because we are targeting both improving the gross card issuance as well as controlling the attrition. So towards this end, we have done several steps. We augmented our digital acquisition capabilities. We launched a new journey like a sprint for acquiring a new to bank kind of customers. Similarly, we augmented the product bouquet with the addition of even the newly launched cashback SBI card. So we are reasonably confident having kind of robust channels, both the banker channel as well as open market channel for acquiring. The volume we are reasonably sure this will continue. Spends wise, our spends have grown at SBI card as compared to degrowth what is witnessed in the industry. This has come in the light of higher transaction share. Transaction growth, which is attests to the fact that it is more of a retail play rather than a wholesale of a corporate card spends. Both point of sale and online are doing well in several categories. All the key spend categories we have seen, the levels have come back more than the pre-COVID levels. We are sure that this robustness will continue.
So your share of spend is now about 18%, sir, right?
I think 17.6 or so, I think.
Right.
Okay.
No, is this, so both cards, share of card, share of spend, is the market also growing? Because overall industry is, net issuance of cards is down a little bit. Maybe because, I mean, the issuance was very high in previous months, so it slowed down a little bit. So is there, within an industry what's your prognosis for industry growth, and within that, I mean, you growing?
I think the industry figures for the month of August are a bit colored in the sense like it doesn't actually capture the net growth of cards, excluding the impact of these inactive cards, when the cards which remain inactive for more than 12 months, which have to be taken out of the card base unless the customer gives an explicit consent for continuing the card. I think that action is happening for different players at different times. I think large number of players attempted in the month of August, so which is the result like where the base has suddenly come down by more than 2 million. With SBI card, our model being a kind of fee-based cards largely, generally our active rate is much higher. Inactive portfolio may not be more than 5 to 6%. So even in this portfolio, whatever call has to be taken, we will take the call in September. So for a month or two, the base may be volatile. But I mean, as we always say, while we keep a watch on the market share, we are more focused on a sustainable growth, more in terms of what net rate will work for us. So we'll continue to focus on the key things that matter. What's the
this cancellation inactive cards would happen, or is just started for the across the board for the industry?
First time it was it started from 1st of July. So obviously covering the entire portfolio. Each of the players would have reached out to the customers for seeking their consent. So large action will happen in August and September, but subsequently it's a BAU affair. Every month, whatever comes under this category, they have to be closed.
Okay. I just wanted to clarify some numbers. You said your card spends have gone up compared to industry average, right? In the month of August, the average spends came in at 13,250 rupees, which was not bad. I mean, on an average, you've been doing it for the last couple of months. What is the run rate that one can expect? Is this 14,000 something that you can do? Or do you think it could even get better, given that, demand has now picked up?
I refer to the increase at the absolute level. More of a volume, definitely it has increased marginally. While for the industry, it has come down marginally downwards. I think there is a play for the industry. There is a play of corporate card spends, which are highly volatile, which are more like a top line game. That also gets built in this per card kind of spends. At our level, I mean, as guided in the last analyst presentation, we are having a relook at the corporate card spends. It used to account for 22 to 25% of our overall spends. It has come down to around 15-16% in the month of July and August. We want to play in a calibrated way. We will have a kind of ramp it up only over a period of time. So to that extent, obviously, again, the spend per card will increase gradually for us.
Mr. Rao, how are revolve rates going to pan out from here on? Are they? Do you see them increasing? And how is that? What's the impact of that going to be on profitability overall, in your assessment?
Of course, for the current quarter, we have to make an assessment at the end of the quarter based on what is the absolute amount of revolver, what is the base also. Because as we are entering the festive period, definitely the spend volume will be high in the last 10 days. So that will have an effect of elevating the base. So we have to take a calculated, we have to make an assessment at the end of the quarter. But having said that, the improvement what we wanted in the revolver, I think it is not at the desired pace. It's not only for SBI card, it's for the industry as such. So I think we are waiting and watching, but taking necessary steps, whatever is possible in terms of creating enabling environment, getting a right type of customer who has a propensity to revolve. Of course, while keeping a watch on the credit cost as well, because we only want to operate in a range-bound manner as far as the credit cost is concerned.
Okay. You said that now you're relooking at your corporate card spends because the demand is definitely picking up over there and you look to ramp up that space. Any other strategies to gain market share? Because your market share in spends has actually gone up to about 17.5% as on August. Any targets that you have and any other interesting ways to sort of ramp up market share over the next 6 to 12 months?
I think we will, as I said, corporate card spends, it's a volume game. So we will play it to the extent like it works for us. But the focus is more on the retail, where we want to work on improving the engagement with the customer. For example, during this festive time, we have come out with more than 1,600 plus offers rolled out by partnering with both online as well as offline merchant across the tiers. Idea is to make the shopping experience of the customer more rewarding. So that way, retail spends have a better propensity to add to the revenue and the bottom line. So the focus will continue to be on the retail spends. And overall, we would like to keep a market share for the spends at the same level or higher than the cards market share. That is the objective.
All right, Mr. Rao, thank you very much, sir. It's a pleasure. Thank you very much for joining us with all of that perspective. It's always good listening to you. So SBI Card doing quite well. I mean, in the month of August, after many months of decline, market share moved up. And, I mean, sounding confident overall. 903 SBI Card, was, I think, flat to slightly high yesterday. It's flat today as well. In a market which is not. Markets are down. But the Nifty also is coming back quite nicely from the day's low. We've come up from the opening levels quite a bit. The low was 16,825, and we're about 80 points off from the low. So this is now a green bar that we have, a green candle that we have for the day already. All right, we'll take a quick commercial break here. We have Rahul Bajoria of Barclays and Upasana Bharadwaj of Kotak Mahindra Bank who will join in to talk about expectations from the RBI policy. We also have a little later Soma Sankara Prasad of UCO Bank to understand the business outlook going forward. Stay tuned.